Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
This is going out there. It's June 21st. And I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Wow, so much to talk about. Maybe not today, but over the past week. And today's Wednesday. And whenever they have Powell on the Hill, we usually have comments from it, but when they're actually broadcasting it live on CNBC and Fox Business and stuff, it usually means there's absolutely nothing going on with the rest of the market. A little bit after earnings season, FedEx reported, not so good, but there was some good parts to it. Margins expected to go higher. Yes, they're seeing a little bit slower demand. But a few things. Stock was down a little bit, and then as I'm taping this, it's only down a little bit. Came back. But lately, I've been getting so many questions from subscribers. And they're asking me, Frank, how do you play this market? It's really crazy. Unusual times. What should I do? Should I go all in? Am I missing this? The FOMO? And that's always, I tell you, all the emotions, that's the biggest when you feel like you're missing out. And that greed factor when other people are like, oh, I had NVIDIA and I had this, and you're missing out, and you're getting in late and then you get crushed. But it makes sense. I mean, it is a crazy, crazy time. We're in an inflationary environment where the Fed's doing everything in its power to slow growth. That's what they're doing. How are they doing that? They're raising rates. That's probably the fastest pace in the Fed era by over 2,000% less than 18 months. From 0.25 to over 5%. And they're not done. And also by slowing the purchase of mortgage-backed securities and treasuries, which, QT. QE is the buying of bonds. When you're doing that, they're printing money to buy assets, right? So they're constantly adding liquidity to the market, which is something that we've seen for over a decade. But now what the Fed is doing, and QT rates are higher, they're taking liquidity out of the market. And if you look at these policies so far, they've worked to some extent. Seeing earnings for companies falling year over year, demand coming down, the economy slowing, picked up a little bit last quarter, expected to slow later this year, consumer spending starting to slow. Banks are tightening credit standards. And when you see these conditions throughout history, normally, when the Fed is aggressively taking liquidity out of the markets, multiples of stocks usually contract. Again, demand falls, prices come down, margins get hit, earnings start to decline. I'm kind of seeing that, right? As the Fed is aggressively raising rates and removing liquidity from the economy, you're seeing this happen real time, and it needed to do this at an aggressive rate because inflation is where? It hit 40-year highs last year. It's coming down. It's moving in the right direction. Again, normally, this will result in lower stock prices. Normally. This year, however, the NASDAQ is up close to 30%. It's had its best 5 months to open a year in its history. There's a lot of confusion. We see the Fed raising rates, inflation is moderating, yet unemployment is very strong. What? Wage growth is strong? How could that happen? Housing, I don't know if you saw the latest numbers from this week. Holy cow. It's starting to pick up again. Pretty big deal because this is a major component of CPI that they have very little control of. And they made it this way over the past 30 years. They made it so, especially rentals are a big part of this. Why? Because rentals almost never go higher by a huge percentage. Even pre-credit crisis, where we saw home prices go up some 20% a year and going crazy for like 2-3 years straight, rentals kind of went up not that much. A few percentage, 3-4% wasn't that bad. They weren't going up 10%. They weren't made for that. So that's why they made this. They say, hey, you know what? We want to try to make this index show as little inflation as possible. It's the reason why for 10 years we all saw inflation with the bills that we paid. But the Fed always told us it's below 2%. There's no inflation in the market. even though every one of our bills paid. That's why. So maybe some of us own our houses and not rent them. But it kept that rate pretty low, that inflation rate for CPI, and now it's biting them in the ass. And now housing is supposed to slow. Supposed to. But did you see the latest data? Mortgage applications to build new homes up 17% last month. Single-family housing starts surged 18.5%. 18.5%? Again, these are the latest figures released a couple days ago. Home builders, all-time highs, where rates surge from 3% to, where is it now, 6.5%, 6.75%? So normal bull markets also, which includes strong economic growth that's coupled with a normal bull market, which, by the way, no country is seeing right now. I mean, you might be able to pick like the 165th country that's showing growth, but if you look across Europe, they're not seeing growth. Look at China. They're definitely not seeing growth. They're going to announce a major trillions in stimulus. One country that can do it because they don't have too much inflation there. I mean, the figures that they reported, will lower this year than they were last year. And last year, China was closed. That's how bad it is in China right now. Could be a good opportunity as these stocks come down because they have no choice. See, trillions in stimulus, but really, in normal markets, where's the economic growth? And during these times, we usually see what? Oil move higher, believe it or not. Oil usually moves higher when we have bull markets, if you look at history. And that makes sense too, right? Because you're growing more, you're building more, right? But it's down significantly from its highs, something that we're not used to seeing. Look at a large percentage of the gains in the NASDAQ S&P 500 have been driven by 6-7 stocks. Yet outside of NVIDIA, almost every one of these stocks are seeing earnings declines year over year. Yet they're trading at 52-week all-time highs. And also, their biggest growth segments are slowing. When you look at Apple, the iPhone sales, services, which is surprising, worse than expected, iPhone sales are slowing. They never, ever, Apple, follow all my life, Apple never gives out their new phone for free. I know they're coming out with another one in September. They never do. If you can go to any carrier right now, trade in your old phone, they're going to give you a brand new one. Or like a $1,000 credit, and it may cost you like $200, $150. They never do that. That's which demand has come down. You say Microsoft, cloud growth is slowing. It's still growing, but it's slowing from the pace that it was growing at, which means, that's not a good sign when you have a growth multiple on your stock. Doesn't matter. Microsoft's doing great. Cloud and consumer spending for Amazon, slowing. Google, talk about a company that's threatened by AI. Holy cow. Another one that's not really seeing strong growth. And then you have Tesla, which has been absolutely on fire. Don't get me wrong, I love Tesla. I think they're light years ahead of everybody else. Light years. Now they're all going to be using Tesla chargers, and apparently this has been seen as like the biggest bullish sign ever. Fine. Up 13 straight days, up incredibly, well over 100% this year. And most of these names are up over 100%. I think Amazon's up like 56% this year. And most of them are up over 100%. But you look at Tesla, again, it's been on fire, even though the company is doing what? They're lowering prices for their main product, EVs, and margins are falling. Not to mention, almost every one of these companies are laying off employees. I mean, do you lay off employees? If you really think the next 12 to 18 months is going to be positive and the economy is going to come roaring back, would you be laying off employees? I can see the first couple rounds, they're still doing it. Yet they're trading at their all-time highs like business is absolutely perfect. Again, something we're not used to seeing. Probably why I'm getting so many questions. When you look at this, you see the confusion. I know why you're scratching your head wondering, how the hell do I play this market? Hell, even the Fed. If you look at the Fed, has absolutely no clue. I mean, saying inflation was transitory 18 months ago. We all know that story. Then raised rates from, I just said before, 0.25% to over 5%. And you can say, well, that was a little while ago, but what about now? I mean, the Fed knows less now or is more confused now than they were then. And they could have been more wrong on anything. The exact opposite. They were pounding in our heads. They told the president of the United States, got on and said, all the economists and the Fed says it's going to be transitory. 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 We heard that. It wasn't, not only was it not, it was totally the opposite. They're like, holy shit, because, this environment's different. You can say, okay, Frank, we talked about that already. But what about today, the latest meeting, right? The Fed last week. said it's pausing but expects to raise rates later in the year. What the F does that mean? I mean, it's being called a hawkish pause. A hawkish pause. I mean, for reference, we've never seen the Fed, who's supposed to be the most transparent organization in the world. And they do this on purpose since their comments, which they all speak publicly, not just Powell, all Fed presidents. They speak publicly and tell you what they're going to do all the time, right? They have to be transparent. And they want to be, because literally trillions of assets could go in and out of the financial markets based on what they say. If they're like, well, we're expected to keep rates the same next quarter, and that's what we see going in, and then into it, all of a sudden they raise by 50 basis points, you're going to see a massive move in the global markets. Right? This is the most powerful organization in the world. So especially since a credit crisis, the Fed purposely makes sure that there's no surprises. And there's been no surprise. Everything that they said they were going to do and the percentages they said they were going to do, they did. They did. The comments afterwards might have been different, but the rate hikes or the pauses, they were all expected. And that's what they want. But we've never seen the Fed like this or say something like that. Say it's pausing now, but you know what? We're going to raise later. It's like telling everyone to go on a diet starting tomorrow, but next month we want you to eat McDonald's every single day for 2 months as we all get in shape together. It makes absolutely no sense. I mean, if you look at the markets, what's the biggest threat? Even when you buy options, what's your biggest risk? It's time. You don't know what's going to happen in the future. We try to look at history to predict the future. We'll look at different things. We do this for a living. You know, that's the goal. That's what AI is all about. We want to be able to predict the future before it happens. But we all can't, and you can't. So since you can't predict the future, act on what we know today. We know today that inflation is still very, very high. It's very high inflation. Yes, it's moderated, and people think it's going to slow. I don't know, because housing is going back on fire to the point where my house, which I'm about to sell, I just looked at the price, the average price, and houses are still flying off the market. Yes, I live in Florida. It's up 5% from last month. 5%. And if you look back historically and go back, 30, 40 years, you usually see home prices go up 2%, 1.5% average annually. Yes, you have inflated markets and it'll go up more, and then you see crashes after the credit crisis and, the ups and downs. But usually, it's up 5% in a month. I think this is supposed to come down. That's insane. Seriously. If you own a house, go to Zillow and look on Zillow of where it is. I bet you it's higher now than it was 30 days ago. It might be down from its high because it declined the past few months. But all of a sudden, and yes, it is the season to buy houses. People like buying houses now, and their kids, they could go travel and stuff since they're out of school. But holy cow, this is a big part of the CPI. So inflation is still very, very high, over 4%, and we've never been over 4% annually since 1991, with the exception of last year, we went 9%. So it's still very high, even though we're moving in the right direction. So we know that. So we know that unemployment is still very strong. We see the markets surging, so why not raise now? Instead, you're going to choose to raise later when you can't predict the future, but here's what could happen. The market could possibly sell off significantly. I mean, we're at valuations that are incredibly high. You could say that 20% ago, or 10% ago for many stocks. So now we have a possibility of the market coming down over the next few months, maybe, while inflation stays high, since, again, housing is on fire again. Unemployment is not really going to change too much over 2 months. Still historically low. And what are you going to do? You're going to raise into that type of market because inflation's remaining stubbornly high? That's the setup? That's what the smartest guys, the so-called smartest guys in the room, that's your setup? That's your advice? Are you kidding me? I've never heard that from the Fed in the 30 years I've been covering this. So when you see the smartest guys in a room that are super confused, don't beat yourself up for feeling the same way. Because there's no playbook right now. There's no reference. There's no data points to look back on and say, oh, remember, this happened at this time, and now we're going to see this pattern happen at this time, right? They always say, the past may not predict the future, but it rhymes. There's nothing that's predicting what's going on right now. Nothing. And this shit never happened before. Locking down the entire freaking world? funding other people's wars with unlimited budgets. Like, we're seeing money. Oh, we made a mistake. We made an accounting error, and it's $5 billion. It's like unlimited. Whatever you want, here you go. Just keep giving money. It's not like, hey, we're going to give you this. Let's see the progress. There's no place. It's not like, hey, let's just unlimited. Keep printing. Doesn't matter. I mean, $32 trillion in deficits. I always said deficits don't matter until you can't pay those bills. If you're not paying a debt, that's in trouble. We're starting to see that. Of course, banking's loan loss reserves are starting to go higher and higher. $32 trillion in deficits right now. $1 trillion just in interest payments. We have earnings and sales slowing for the S&P 500 company. Fact, slowing. Down year over year in earnings, barely seeing sales growth year over year. Interest rates absolutely surging. Yet stocks are hitting 52-week highs. Mortgage rates are the highest they've been in decades. Maybe a little bit off of those highs. And you're seeing the housing statistics that we're seeing. And again, home builders at 52-week highs. And they've been very adamant about what they're seeing. There's a supply concern. People want to buy houses, and we are building like crazy. And they've been saying this pretty much for over 2 years now, and people are like, okay, well, mortgage rates, and they come out and you expect it. Like, you expect the holy shit, okay, demand's falling off a cliff, and they keep reporting these blockbuster numbers, keep raising, buying back stock. I mean, these guys have never been stronger in their histories, and you're waiting for it. You're waiting for it, especially past 6 months with rates rising, mortgage rates rising. You're waiting for it, and it's still raising. And it's not like they're seeing it it's not like they're seeing it with technology where earnings are declining year over year and they're firing employees. No, you're not seeing that in the home builder sector. It's roaring. And maybe that changes next quarter, the quarter after, but these guys, all of them together, are saying the same thing. We're building like crazy, seeing demand surge. Yeah, home prices are down in some areas, but still seeing demand. So it's a crazy market and things don't make sense. Then before you run out and sell stocks, say, I'm done with this. Want to get out of it? Maybe dump in treasuries or an Apple savings account, which offers 4.5% to 5% yields risk-free, which, by the way, you should have an allocation to, especially if you're retiree. You want to have some risk in the market. You want to speculate with capital, no matter what your age is. I don't care if you're 98. You should speculate a little bit with a small portion of your money, just a small portion. Of course, that percentage, will be higher the younger you are. But you want to have a little exposure. But enjoy those. Enjoy the risk-free rates. We haven't had this in 15 years. Risk-free at 4.5%, 5%. That's awesome. Before you run out and say, oh my God, I just can't take it. It's so confusing. I don't know what to do. I can tell you one thing that's certain. One thing that's certain. Volatility, huge price swings, the Fed not having a clue, raise, pause, we'll wait, and this confusion. These conditions are not going away anytime soon. And I'm talking years. This isn't like an end of the year thing. Look, we were supposed to raise rates and start lowering. Remember, we were saying 9 months ago, we were talking about the Fed lowering rates in February, March, April. It's June, and they're out saying, okay, we paused, but we're still raising rates at the end of this year. Something that we've been adamant about, we told you. There's no way they can lower rates. Inflation's just too high. It's coming down, so in the right direction. It's still extremely, extremely high. We would be very nervous right now if the inflation rate was 4.5% and it wasn't 9% last year. We would be like, holy shit, how do we get this down? This is crazy. We haven't seen this in 30 years. But since it was 9%, 4.5% looks pretty good right now. But that's for certain. These environments are going to be nuts and confusing. And it's going to be around for years. But the great thing about markets like this is we see so many assets, stocks, even bonds, they get mispriced. Both ways, on the upside and downside. You take NVIDIA, seeing tremendous growth. Now it's trading at 40 times sales, 6 times forward earnings. And if you look at the average price to sales for the S&P 500 company, it's 1.7 times. Again, NVIDIA is at 40 times. The average PE right now, well, usually, if you take the 10 years, it's 18. They're trading at 60 times forward earnings. Now, NVIDIA, like Netflix, Apple, Amazon, Google from 10, 15 years ago, may fit into this valuation based on growth in AI. These reported an amazing quarter. and then being an industry leader. However, their margins are 70%. Massive margins for, it's not purely a hardware company, but for these chips, 70%, which is why everyone is coming for them in terms of building the best AI chips. I'm not just talking about AMD and semiconductors and Intel, geez, they've been so behind the curve. But I'm talking about Apple and Google building their own chips. That's what happens when you have margins that big. And these guys, last I saw, have incredibly deep pockets. They could put tens of billions of dollars into building these new AI chips. That's more competition. Maybe NVIDIA figures this out. And don't listen to me about NVIDIA because I've been wrong. I thought the stock going up 100% into the quarter, trading at a crazy valuation. I'm like, even if they beat by a pretty good number, it's probably going to sell off. They blew out the numbers. Good for them. But could they continue with that? I don't know. Maybe. But there's other large cap names that are trading at insane valuations while they're seeing very little growth, which is unlike NVIDIA. I think we're going to see a lot of these names get hit in the next earnings season. Why? Because expectations are now sky high for these names. Now, what do I mean by expectations? It means the analysts. The analysts have been significantly lowering estimates for the past 3 quarters. So when you see Microsoft beats and Apple beats and all these companies beat, they wouldn't have beat their original estimates. They're just down 8 to 10% going into the quarter. So they beat that number, which is fine, which still happens to be slower earnings growth than they saw a year ago for almost all of these technology companies outside of NVIDIA. So now analysts are starting to raise these estimates as we're seeing more optimism. Some stocks going higher, the market's going higher. So now expectations are really, really high and valuations are really, really high, which means you better beat. And not every one of these companies are going to beat. Some of them will. Maybe NVIDIA beats again. That's fine. But a lot of these names, again, they're still laying off employees. They're seeing their biggest markets slow down. They're doing fine, but should they be trading at their highest valuation and 52-week highs in this environment, where the Fed is doing everything in its power to purposely slow growth? So watch out, because many of these names are up 100% year to date, which is insane. They put more weak results. They come out with those weak results or weak outlook. Watch out. We saw this a month ago with some retail names. Some of them bounced back, but we saw 15, 20% declines in like 5, 6, 7 stocks. They covered it. Unplugged Premium. We could easily see these declines. Again, with stocks up 100% heading into the quarter, a 20% decline is not crazy, especially if you're not meeting those expectations or if you offer weak guidance. We're seeing the biggest disconnections of small caps. And then NASDAQ, if you look, you can see a chart of this. And do year to date. It's unbelievable. The NASDAQ is outperforming the Russell 2000 year to date by 23%. I can't remember ever seeing this wide of a gap in my 30-year history. I have to look back. I don't remember seeing that kind of gap because we also had small cap names rising during the .com era. I've never seen something like, I've never seen that, just the gap of 12. You just see 5%, 7%. Maybe you see 7%. You said 23%. Holy shit. And you look at small caps, many of these names already cut costs. They're starting to see their supply chain concerns ease, which, by the way, supply chain concerns, if you're looking at Goldman, if you look at so many companies, and I track this for a long time to see who's full of shit, blaming supply chain concerns and demand when it was really demand, companies like Ford and stuff like that, there's no supply chain concerns. Like Boeing could say, well, we see a little here, we see a little. If you look at the supply chain concerns based on their index is lower today than it was in 2008. That should not be a concern. Otherwise, you're doing something wrong. It's easy to go to another supplier and get what you need right now. Maybe there's, again, some examples of things that just are hard to get. But overall, when you look at the industry, supply chain concerns ease incredibly. It's not a concern anymore. So a lot of these names cut costs, small caps. Yet the difference between these names and small caps, some of the largest tech stocks, many of the small names are still down 50, 60% from their highs. Wouldn't think that, right? Because the market's up and the S&P 500 is up. And, again, it's contributed to a lot of stocks. We've been down like 3 days in a row after hitting new highs. But a lot of these names are down significantly. It's why we're seeing huge inflows into this sector over the past few weeks, and especially last week. And this is factual. This is based on the Bank of America inflows, outflows. If you subscribe to my newsletters, I usually show this and show just some of the sectors. It's good to see like trading opportunities and stuff. But money is actually flowing a little bit out of tech finally. But now you're seeing small caps as this allocation in technology has gotten bigger and bigger, and some of these funds have gotten it right, that now the allocation as a percentage gets bigger. Now they have to reallocate that money someplace. And it's going to, I'm not saying the whole Russell 2000 and buy the whole Russell 2000. I'm just saying the ideas I'm seeing here are incredible from a risk-reward standpoint. I brought up Macy's. And Macy's is a company that lowered guidance significantly. They reported on June 1st, a couple weeks ago. Significantly. They expected to earn $4 a share at the end of the year, and they said now it's $3 a share. And they already lowered kind of like, had kind of a weak outlook and said, we're seeing consumers really, tail spending and, curb their spending and stuff like that. But the reason for the miss is the worst that you could say. It said weak traffic, weak sales, and it was across many segments. It wasn't one thing or two things or something at one time. It's weak traffic. And they said they expect these conditions to continue for the rest of the year. 25% they lowered earnings. That is massive. It's massive. So you even saw digital sales fall 8% from last year. I mean, everyone's digital sales. I can't say everything because digital sales have gone up so much since COVID. I mean, some of it, but everything, every part of that business. It wasn't one thing you could point to and say, wow, look at Macy's, that's great. So stock was $13.75 when it reported. You know where it is now? It's over 15. It's over 15. After significantly lowering, not next quarter estimates and keeping their yearly guidance, but their year for the rest of the year. Significantly lowering those numbers. So why is Macy's higher? Because Macy's was trading at a 52-week low heading into the quarter. Shares were down 45%. They were $25 a share a few months early in February. They were $13. So the risk was already priced in. Now, I'm not saying to go out and buy Macy's. There's other plays in our newsletter that we like better than that. But it is an example of how small caps have gotten crushed. And a lot of them haven't come back yet. Many are still down 40% plus from their highs. And the risk reward, even in this environment of slower growth, is very compelling. And for me, I recommend a small cap stock every month in my Curzio Venture Opportunity newsletter. I always come up with a new idea, research a lot. And I have to be honest with you. It starts off with 15 or 20 different things I'm looking at, and then it filters down. I'm like, wow, then maybe one or two ideas, and I'll pick one of those ideas. That's usually the way it goes. I'm seeing dozens and dozens and dozens of ideas right now. Things that make a lot of sense. Things that companies would be like, oh my God, it sounds so crazy. Really? Because there was private equity companies trying to buy a specific company at double the price 6 months ago. And that's how far this name's come down. And they own all their real estate for their stores. And it's not just a value play because you need some kind of growth catalyst. There are growth catalysts. You saw last 2 quarters, they reported pretty solid results. Not giving you the name of that, it's in one of our newsletters. But many of these names are mispriced because everyone's focusing on one sector. It's a large cap tech. Now you see the smart investors, the big funds, they're starting to sell tech. Again, that's as the latest Bank of America flow of funds report. They've been selling for the past couple weeks. And allocating a portion of their capital into small caps. Notably, believe it or not, into consumer discretionary. It makes sense if you're watching the markets, cruises, restaurants, hotels, EVs, places that we're in our newsletter. And the other place I'm seeing a huge mispricing of assets, it's crypto. You heard me talk about crypto a lot of this podcast. We actually tokenized our company, offering equity stake to investors, which I think is a fascinating thing that's going to take off one day. You're looking at crypto and saying, Frank, this is the shittiest industry. It was crushed. 2022. It's terrible. Bankruptcies, fraud, regulatory issues where the SEC said, we're going to regulate this for 3 years and just said, we're not going to regulate it now. Shut down a couple of banks. People think it's dead in the U.S. Made the top 100 names in this space, and there's over 3,000 that I've researched, at least over 2,000. I should say really detailed over 1,500, but others that I looked at, and 90% of this industry is complete shit. I said that. But man, that 10% and a lot of these big names, the technology and the innovation that's coming out of them is incredible. It's incredible. And this year, Bitcoin and Ethereum are doing fine, up 50, 60% this year. But when you see all these problems and the fraud and the I told you so, and now, the initiative between the government saying, we're not going to regulate this, kind of shutting down banks, even though they did nothing fraudulently, which is illegal, by the way, and they're getting sued, and they're going to lose that suit. The government, yes, lost a similar suit a couple of years ago, Operation Choke Point, look it up. But it led to a mass exodus in so many cryptos. People are like, I'm out of this industry. It sucks. This is a good thing. The junk is getting wiped out. We see this over and over again. A boom-bust pattern. Throughout history, pick any sector. You're going to see what AI. You know how much money it costs to implement AI? I mean, this money in NVIDIA is coming from the biggest companies who have hundreds of billions to spend, right? And balance sheets and stuff. Do you know how much money and how much money companies are going to lose on AI for many, many years before they get this right? It's like data analytics. You're going to lose a lot of money getting that right because 95% of your data is shit. It's the 5% you have to learn to capture of how you could put AI on top of that and predict the future. Again, trends I've been following for decades. But the boom and bust is normal. And after the bust, what happens? Survivors usually go on to become industry leaders. So those claiming crypto is dead, it's gone. It's not. We're still in the very early innings. BlackRock just filed to launch the first ever Bitcoin ETF. Other companies have done this and have not been successful. They weren't BlackRock. BlackRock has over 10 trillion assets under management and huge political influence. This is a company that would not do this unless they were absolutely sure that it would get approved. They wouldn't waste their time. They're in everything. They're the largest holder of almost every large cap stock. They wouldn't waste their time. And believe me, the political ties that they have, now that you got rid of a lot of players in the industry, BlackRock all of a sudden, now, pretty amazing. New crypto exchange launched this week, US. It's backed by private equity giants Citadel, Paradigm, massive equity funder in the entire industry in crypto, Fidelity, and Schwab. This week, they launched with 4 cryptos, Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. Now, to put this in perspective and why it's a big deal, Schwab and Fidelity, last time I looked, they have a lot of clients. Schwab has 34 million active brokerage accounts. Fidelity has 37 million. And both have trillions in assets under management. So 70 million people will now have access to these cryptos, these 4. Many of them for the first time ever because people have trouble. It's not the easiest thing. It's kind of easy on Coinbase to buy cryptos, but it's not the easiest thing to buy cryptos. I get it. It's gotten a lot easier over the past 2-3 years. But now it's going to be really easy for 70 million people. Again, like BlackRock, Citadel, Fidelity, Schwab, have close ties to politicians and regulatory authorities. Believe me, when you're working at the SEC, even if you move up the chain, you don't make a lot of money. You make a lot of money when you go and Goldman Sachs and then they give you $5 million a year after making $150,000 a year. There's a reason why if you go back and look this up and you'll see the top people that you see that left, they all work for major financial companies, the biggest in the world, and they're all getting paid a fortune. That's how the system is. These guys know when shit's coming. That's why they have slush funds on the side. Whenever they get, okay, the government's coming after them, we're going to have no fault, and here's 20 million, here's 50 million, here's 75 million. Nobody even cares anymore. And I'm not just talking about brokerage firms, the Goldman Sachs, the biggest banks, JP Morgan, the fines, constantly. Epstein, constantly. All this stuff just goes away. All these guys, big circle of trust. These guys aren't going to launch something like this if they thought crypto would be banned in the U.S. or if they believe crypto would not be a massive growth market in the U.S. for decades to come. It's a $1 trillion market. It got to $3 trillion. Trillion dollar market. I know we throw that number around a lot and we're like, it's a trillion. It's $1 trillion. I mean, AI is going to take 5 to 10 years to get to $1 trillion market. EVs. I mean, all these trends that we're all hyping up and, oh my God, this is great. I mean, before they become crypto's $1 trillion market. That's how big it is. But crypto offers an incredible opportunity for investors because so much of the innovation is taking place. And it's the one area of the market where you can invest in things like AI, the multiverse, the metaverse, whatever you want to call this, fintech, during the very early stages of growth. And now when these things IPO at 40 times sales, when most of the growth's already priced in. When you look at crypto, the Apples, the Microsoft, the Amazons, these names of crypto, they're on sale right now. These are the biggest names. And I would suggest putting a little money into some of these big cryptos, whether it's Bitcoin, Ethereum. And you can see how this news, and this news is recent. I'm not picking this news, they're BlackRock. This is like the last week and a half, 2 weeks. And you can see how this news is driving Bitcoin sharply higher while the market's coming down the past few days. Now, I mentioned last week that we have 3 newsletters that target these themes, which is rare. Usually I'm like, wow, small caps are great, or shorting some of the large caps are great, or crypto. Right now with these 3 areas, it's what I'm doing personally with my money. This is where I see the most opportunity over the next 12 to 24 months. And let's look at those 3 products. The first one's Money Flow Trader, which I mentioned a lot in this podcast. Buys long-dated puts, betting against stocks and sectors. The market's up sharply this year. But where do you think it's going to be 6 to 12 months from now? Because you really only need a 20% pullback in one of these names. This is Gina Terranova's product. She's amazing at this. But you just need like a 20% pullback pretty much in the first 6 months. Right? It's usually like a year put most of the time. Long-dated puts. And you can make a lot of money. Easily more than double your money. I mean, during COVID, Jenny booked tons of 100% winners. She did it again in 2022 when the markets fell sharply. But now in this market where we're seeing so many large cap names trade at crazy valuations, seeing slower growth, and we're going to see slower growth. That's what the Fed's doing. It's a product that can make you a lot of money in a short period of time while also protecting yourself. It's not a product that you invest all your money, all your capital in, a product that maybe you invest 3 to 5% of your portfolio, and people call it insurance. And when you say insurance, it's insurance, whatever. That insurance booked 500% gains, 300% gains, 200% gains. Granted, when the market goes higher, and you're buying these puts, you're going to lose money. And you're only going to lose the money that you put in to the trade, which limits your risk. So it's the opposite of shorting. For example, I thought technology was overvalued in February. Pretty dumb call. Buying long-dated puts on it. And I got wrecked. Now, if I shorted the market and I got wrecked, I only lost the money I put into it, which wasn't a big deal. But if I shorted this market, I'd probably be divorced and sleeping on a park bench right now, trying to broadcast someplace, use somebody's studio. So buying puts, it's safer than shorting. And it's a great strategy to bet against the market in sectors. Because if it does happen, that 3 to 5% could become easily 40, 50% of your portfolio. And Jenny does a great job of that. The next product is Curzio Venture Opportunities. This is a product I'm really excited about. You're seeing some of the names right now do very, very well. So my flagship product, the first one launched Curzio Research. But the opportunities I'm seeing are incredible from a risk-reward standpoint. We currently have 7 stocks that are buys in our portfolio. So several names start to move significantly higher. Again, we're part of hotels and Norwegian cruise lines. We have some of these names in that portfolio. And we've had them before this recent move up. So we're doing very, very good. We're seeing a lot of money going to small caps. Again, these are just beaten up names that I'm looking at going like, holy shit. You just need okay news and these things are going to go up 20%. This newsletter also offers private placements, which you're going to see a lot of over the next 12 months. They have great ties to the mining industry. It took me a while to get on the inside of that industry. And by the inside, meaning I'm not getting ideas 5th or 6th and using my newsletter to launch just like private placements right in your face to get the stock higher, and then it crushes it, you crush your investors. No. I'm talking about investing alongside the greats in this industry. Again, it required a lot of work, a lot of being in the room at meetings, going to Vancouver, which is pretty far away from Florida, if you don't know, 4 times a year. But I think gold and silver are great bets over the next 12, 24 months. And getting some of these private placements where, they want to build, they want to grow. You have gold and silver ramping higher right now. A lot of these stocks have not really participated, but these guys are also offering warrants, which is pretty cool. So if these names do take off, it's almost like making double from your investment since you own warrants. And it's basically free money. The stocks go higher, the warrants could exercise and you could sell them. If the stock does not go high, the warrants expire and you lose nothing from the warrants. You have to be an accredited investor to invest in most of these private places, but you don't have to be an accredited investor to subscribe to Curzio Venture. 90%, 95% of these names. With regular small microcap recommendations you could buy in major exchanges. It's very easy. We explain all that to you. And then we have Crypto Intelligence, which has become one of my favorite newsletters because I've never learned so much in a 3 to 4 year period. Learning these technologies, the fact that these guys don't know how to talk on below, I don't even know what level. I mean, usually we try to write in 6th, 7th grade level, smaller sentences, try to make people understand things, right? You increase your total addressable market, the more people can understand. In this market, holy cow, learning these technologies and the way they write, I got to read this stuff 2-3 times. But it's an incredible newsletter. So one time, the average position, if I had to guess, maybe like 12 to 15 names, it was up over 600%, the average position. In 2022, we got crushed. And the best names fell 70% plus. We're coming back a little bit this year. But I can honestly say from crypto, I made the most money in my life investing in this sector. It offers you one of the best risk returns in any asset class I could think of. Is it risky? Yes. But it deserves a small allocation of your speculative capital because the gains that you could see could be life-changing, even for me. Mostly responsible for me building my own house. Which, again, I always say this, I don't apologize for working my ass off. Nowadays, you have to apologize. Oh, I'm sorry, I didn't mean to. No. But a lot of that was due to crypto. And you think about the bull market post-COVID. SPACs became super hot. You take the best performing SPAC, say Lucid or even Virgin Galactic. These names went from $10, which a SPAC usually comes out with, and they went to 50, around 50-ish, I would say, at the highs. That's 4x returns. That's amazing. That's great. I mean, forget the fact that these are bullshit companies that are all trading in low single digits right now. But say if you bought when it went public at 10, sold near the top. That's 4x returns. Again, pretty cool. We had several names up 10x. One name up 40x. Not like one name and two names. There's like 4 or 5 names like this. I've seen things in this industry go up 50 to 100x. And it's not cherry picking a name here or cherry picking a name there. Again, the risk, same risk with stocks, right? You can lose your money, what you put in stocks. We limit our position sizes, try to limit the risk. The most you can lose most of the time is 6%. We might go 8%, very rare. But these are gains you can't get in the stock market anymore. And everyone should speculate. So I'm not saying throw all your money in this sector. But when you're looking at the valuations of the companies that come out in the stock market, where they IPO at or SPACs, which is pretty much a dead market, I mean, you're looking at names where you just can't capture the growth. Most of the growth's already priced in. But crypto, the best names, the most quality names, the best innovations that are run well, that should have no problem in terms of regulation, these names offer incredible opportunity. And now, these are names that 70 million people, trillions in assets, will now have access to. Again, some of them for the very first time. But crypto is definitely worth a small allocation of your speculative capital. It's worth it. The gains could be that great. The gains that you can't see in the stock market, you could see here. Is it risky? Yes. But for me, and going through these and being very careful from a risk-reward standpoint, crypto right now, I think, offers an unbelievable opportunity for investors, especially over the next 12 to 24 months. So now, last week I said they were discounting these 3 premium services significantly. As I explained, I see a lot of opportunities in these products over the next 12 months. Usually you don't see more products. So I usually sell these things for $5,000. That's the retail value. Sometimes we discount them. We've never sold them at $1,000. Each one of these products are going to be offered for $1,000 for the next 12 months. So I'm sending you an offer next week, very early next week. Go to everyone on our mailing list. If you're not on mailing list, you can go to CurzioResearch.com, scroll down the middle of the page, put your email in the box. We're not going to send you a million emails. We send a ton of free content to show you what you're all about, especially if you're new clients. Send your best offers sometimes. We're not flooding your email box. But the $1,000, it's a one-time offer. We never discount our premium service by this much. It's likely not going to happen again. But with this offer, and I talked to my team about it, I want to offer something else. So the first 100 people who subscribe, and by the way, we have over 100,000 people on our list. But the first 100 people who subscribe to any of these products, you'll get the opportunity to talk to me directly for 10 minutes. Which I think is pretty cool. And my time, just like your time, is precious. It's valuable. It's very valuable. But on this call, you can ask me anything. I can share with you what I'm doing personally with my money, how I'm using these products. Tell me your concerns, anything. Of course, you know I can't give personal investment advice. When you sign up, it's going to take you to a calendar and pick a time slot. If you're early, it would probably be better. This way, I'm probably going to do it over the next 3 weeks or so. We figured all this out, the time and everything. And you don't have to pick a certain product before the call. You can talk to me first. You can select the product, multiple products after our call, since you may have questions saying which one's the best product for me. I may say, hey, this one is, or these two are, whatever. But something different, probably won't see being offered anywhere in our industry where the guy whose name on the door is going to talk to you personally. But based on the amount of questions I'm getting through this podcast, plus the really great conversations and the friendships that I've formed with many of my listeners who invested in our company. I mean, that was a $25,000 minimum. And I said, I want to talk to everybody before they invested. And even I talked to people before they invested in Curzio One as well. So I want to make sure the product's right for you. I have turned people away. It's very, very high price. You get all products, now and forever, right? For the one price, with just a small maintenance fee. But just the conversations I had with business owners, doctors, executives, hedge fund managers, just even young investors, entrepreneurs. I mean, in terms of network, it's incredible. So I'll talk to many of these people several times a year. So I think it's going to be pretty cool. We'll see. Again, it's going out to over 100,000 people, so you can do the math on that. But you're going to see a special offer next week, 80% off our 3 premium service for only 1 year, only because the opportunities I'm seeing across all 3 of these products are really, really great. And again, if I don't show you gains, you can run and cancel. We're independent. And we have to show you gains. We don't get paid by companies to recommend. But right now, the ideas I'm seeing in these newsletters are really incredible. I know subscribing, you're probably going to become a client of ours for a very, very long time. Because just lots and lots of ideas that I'm seeing. Some I think are going to go higher, and some I think could go significantly lower. And Ginny's going to help you out with that part, Money Flow Trader. So again, first 100 people to subscribe, be able to set up a 10-minute call with me. Be pretty easy to set up. See a calendar with open time. Just put your name in there, and you're good. So be sure to check your email early next week, and that's it for me. For Wall Street Unplugged Premium subscribers, I will see you tomorrow with the one and only Daniel Creech, who's back finally from vacation. I'm going to break down 2 amazing reports. Seriously, one from Bank of America that I talked about, the flow report. It was really amazing. Lots of details in this thing. And one by Morgan Stanley, which is Mike Wilson. Bank of America is super bullish, right, on certain trends that are happening. And Morgan Stanley, Mike Wilson is pretty bearish. So both make a great case. That's the type of market we're in, right, to support their thesis. But Daniel, I'm going to pick it apart and tell you the parts of these research reports you should pay close attention to, which ones you should ignore. And we're also going to recommend a new stock. Actually, I don't think I should call it a stock. A new idea. Hint, hint. That we believe has incredible upside based on several catalysts that just came to fruition this week. Should be able to figure out what sector we're going to. But I'll see you then. Take care.